Hey, what's up, my friend? So have a look at this chart over here. And let me ask you, do you think the price will reverse higher from support or will the price break down? I'll give you 5 seconds to think about this. 345. Okay, let's have a look at another example. What about this one? So notice how the price comes into support. Do you think it's going to reverse up higher or will the market or the price break down lower? Let me give you 10 seconds. 345, 6, 7, 8, 9, 10. Okay, so to know whether the price is likely to break out of support or will it reverse from support, right? You must first understand the two types of move, right? The two types of moves, right? When the price approach support or resistance. Okay, the first move that I want you to learn is what I call a power move. So a power move into support is where you notice a series of big bearish red candles coming into support. So let me give you a quick illustration. So let's say market is in a range, it goes up, comes down, goes up, comes down, goes up, and then it starts coming down, right? This is a big red candle, right? Let's bold this. This is another big red candle, right? Coming into this area of support. So this is what we call a power move. I'll share with you a chart example later on so you can understand it better. But in the meantime, right, a power move into resistance is just the inverse. It's where you see a series of big green candles approaching resistance. So why is a power move significant? Okay, so we'll get to that, right? But first, this is how it looks like. So this is what I call a power move. Notice the big red candles approaching this area of support. So why is this significant, right? For a few reasons. Number one, imagine that someone who is short, right, at this candle or at this area of resistance. The market in a few moments quickly went in their favor. So they're already sitting in profits, maybe $1,000, $2,000. So what happens is that this group of traders, right, they were fear of giving back their profits, right? Have you ever, remember, you hold on to a trade so long, you watch your profits from $1,000, trickle down to 800 to 700, you continue holding until you hit your stop loss, right? You got nothing out of it. So there's this fear of giving back their profits. So traders who are short, right, they have this fear of giving back their profits. So this is why they will look to take profits. And that, right, would help induce buying pressure. So when you are short and you exit the position, it's actually a buy order. A buy order would create buying pressure to push the price up higher. The second reason why, right, a power move into support is significant is because it's coming into this obvious area of support, right? And traders who use technical analysis says, oh, the price is at support, Rayner, let's buy. Guess what? That induces buying pressure as well. And the third point is very important. Pay attention. It's this. Whenever you see a strong power move coming into an area of value like, support or resistance, etc., the reversal can be just as swift, right, towards the upside. Why is that? It's because, pay attention, it's because there is no obstacle in the way, or rather the obstacle, right, is quite far away. Okay, so if you think about this, let's say someone were to buy at this area of support. Okay, let's say he buy here. And ask yourself, right, if you understand market structure, price structure, where is the next area of resistance? It's actually somewhere here. So you can see that from here all the way up to here, this is your potential profit. So you can see that your next obstacle is actually quite far away. So there's no like obstacle in the way, having to induce selling pressure to push the price down lower. So because the obstacle is pretty far away over here. So this is why when you see a power move into support, right, there are times, right, where the reversal could be just as swift, right, towards the upside. So here's another example of a power move into resistance. So again, the concept is the same. The only difference is that, now it's just a power move into resistance. You're seeing a series of green candles into resistance. Now, one thing to be clear is that I don't just trade every power move coming into support and resistance because they're not, not all of them will reverse. So later on, I'll share with you how to actually trade power move. In fact, I'll teach you a relatively simple but powerful support and resistance trading strategy so you can profit in bull and bear markets. Okay, moving on, I want to share with you the second type of move, the crawler move, right? So what is this? So when you see a crawler move into support is where you get a series of lower highs into support. It looks something like this. So let's say this is an area of support. Market goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down. And each subsequent rally, right, you notice that it gets weaker and weaker, right? Because the upside, right, gets shorter and shorter. And if you look from left to right, notice a series of lower highs, lower highs, lower highs. So this is what we mean by lower highs into support, a crawler move into support. Likewise, if you see a crawler move into resistance, you can expect a series of higher lows into resistance. So let me give you an example. So this is what I call a crawler move into support. Right? Notice this over here, how the market, right, made a series of lower highs into this area of support. So usually, when I see a crawler move into support, right, this to me is a sign of weakness. Okay, or rather, this tells me that selling pressure is stepping in. Why is that? And how do I know that? Because you can see, right, that the sellers, they are willing to sell at this and lower prices. So imagine if you are a seller and you're selling close to resistance. It doesn't quite make sense, right? Unless you think, okay, so if support does break, then yeah, looking back, yeah, this is a pretty good price to short at. But if you don't think support will break, then it doesn't quite make sense to short so near support. So clearly the sellers are confident, right? They're willing to sell at these lower prices because they expect support to break. So when you notice a series of lower highs into support, more often than not, it usually lead to a breakdown. And that's not all, because naive traders or new traders, whenever they see, oh man, Rayner, look, the price is coming to support, guess what? They'll buy. And where would they put their stop loss? They put their stop loss just below the lows of support, right? So if enough new traders do that and enough stop loss, right, is below this area of support, right, this again, right, add fuel to the fire. Because if you think about this, someone who is long, their stop loss, right, is in essence a short order, right, to get out of their losing trade. So if the price goes down and hit their stop loss, which is a short order, that fuels even more selling pressure, right, causing the price to head down lower. So for this few reasons which I shared with you, right, this crawler move, right, a series of lower highs into support, right, is usually a sign of weakness, or rather sign that the sellers are about to drive the price lower. On the other hand, right, if you see a series of higher lows into resistance, so you can see over here a series of higher low, higher low, higher low, higher low, had to do that, right? A series of higher low into resistance is a sign of strength. Okay, so why is that? Again, the inverse is true, because you can see that the buyers, they're willing, initially they bought over here, they push the price up higher, market makes a pullback, they buy at these lows, goes up higher, pullback, buy at these lows, then it goes up higher, make another pullback, buy at this low. So you can see that each subsequent low is higher than the one before it. So if you think about this, right, who in the right frame of mind wants to buy just in front of resistance, unless you are fairly confident that, hey, resistance will break, that the price is likely to break out higher. So this tells you that buying pressure is stepping in, right? I think they believe that they are relatively confident that, hey, the market is about to break out higher, so that's why they are willing to buy at this higher prices. And more often than not, right, when you see a series of higher lows coming into resistance, the market is likely to break out. Now let's do a super quick recap. Number one, the market could reverse after a power move into support or resistance, right, as I've explained why earlier. However, we don't trade every power move or trade a reversal, right, just because a power move comes into support. There's one or two other things that I still look out for, and I'll explain to you what it is, right, before I trade a power move. And likewise, right, or moving on, right, the market could also break out after a crawler move into support or resistance. In other words, a series of higher lows into resistance or a series of lower highs into support. Now, moving on, I want to share with you, using these two concepts you've learned, right, I want to share with you a couple of trading strategies that I use, right, to profit in bull and bear market. So let's get to it. Now let's have a look at another example, shall we? So again, the May formula, I'll just do a quick recap here in case some of you have short-term memory like me. MAE. What is the market structure that you're seeing on this chart over here? This is the New Zealand Canadian, the 4-hour time frame. What is the market structure? Downtrend, right? Great, right? Market is in a downtrend. So you know that the market is in a downtrend, then where will you look, right, to trade from? Where is the area of value that you want to pay attention to? In this case, area of value is at resistance. Fantastic, right? So let's cover this first too. So market is in a downtrend. Area of value, I'll probably highlight this one over here. Okay, that's probably the key one that I'll pay attention to. And let me just change this to black, right? So we don't get confused later on with our entries and exit. Okay, and again, for those of you who prefer to have it drawn as a rectangle, you probably look something like this, right, as an area on your chart, right? That's perfectly fine. So all that's left to do, or rather the next thing to do, is to wait for the market to come towards your area of value, or in this case, resistance. So you can see the market head up into resistance, okay, breaks into resistance at this point, and this candle over here, we have a valid entry trigger. This is what we actually call a bearish engulfing pattern. The story behind it is similar to a shooting star pattern, right, where the buyers were initially in control and then they quickly, right, got disrupted and the market got pushed down lower by the seller, closing below resistance. Also, actually, you can see it's actually a false break as well. The market actually took out this highs and quickly reversed back into below resistance. This looks like number one, but anyway, yeah, so this is a valid entry trigger to go long, telling you that the sellers are in control. So what you can do is, again, to enter on the next candle open. So again, next candle open at this price point. Let's put this as green, right, to signify that is our entry point. Okay, I notice there's quite a few black lines over here. I'm going to remove some of them so you can see better. Okay, now what about our stop loss? So in this case, again, you can pull out the ATR indicator, the average true range indicator. I'll just do this one more time. So what we are trying to do over here is to set our stop loss a distance away from resistance because we don't want to get stopped out prematurely. So what you'll do is, again, find out what is the high over here and add on, right, by this number of ATR value. In this case is about 45 pips. So let's do a quick calculation. The high of this candle currently, it shows that it's about let's see, 7885. Okay, so 7885 you plus 45 pips, right? That gives you 7930. So your stop loss will be placed at 0.7930. So I'll change this to rate. Okay, and 0.7930. Got it. Okay, so that is your stop loss level, right? This over here is your stop loss. So basically, how you interpret that stop loss level is that from this high, 1 ATR, okay, add on 1 ATR, is equals to this level that you're seeing on the chart over here. Next thing, right, where is your target? So if you look at target, right, there are two levels that showing up over here. One is this recent swing low, and this one is more of an extreme, further away, right, that swing low. So in this case, usually I like to have a conservative target over here. So in this case, you can actually have your trade, right, all exit at this swing low. That's a perfectly, valid thought process. Okay, but at the same time, right, let me just remove the indicator. At the same time, right, some of you might be thinking, but Rayner, if you look at this market, right, if you look back, this market is actually in a downtrend, Rayner, and the price tends to break below this low, break below this low, break below this low, because you look at this, the price over here, it breaks below this low, and then it makes a pullback. So won't we, like, be giving up some potential profits because we can still look to capture this additional bit of the move, right, as the market breaks down lower, right? So that's a fair thought, right? So actually what you can do in this case is actually to have two targets. One is a more conservative target and one is a further target. So let me share with you how to do this. So in this case, your first target can be over here. Okay, this is your first target. Let me just change this to blue. Let's call this target 1, right, TP1. Okay, and you can have a second further target, right? As you know, the market is in a downtrend. It could break below the lows and go a little bit further. So in this case, this is the extreme low over here. For all you know, this market could possibly, break below this extreme low, right? And then make a pullback. So you want to kind of like take your somewhere about here, right, where you can get the most bang for your buck. So how do you do this, right? So how can you do this objectively? So what you can do is you can use a tool, right, called a Fibonacci extension, right, and look to exit right at just before the 127 extension. So I'll just get out, show you what it means. Look at trend-based Fib extension. Click on this. You draw it from the swing high to the swing low and back up high again. So this is the swing high down to this extreme low and then up higher again. Okay, so once you do that, you can see that over here. I can't see it over here. There, over here. I'll just manipulate this chart a little bit, okay? You can see over here, I want you to pay attention to this level over here. This is what we call the 127 extension. And over here is an objective way where you can look to set your second target. So I'll just draw a second blue line over here just before the 127 extension, maybe somewhere about here, okay? So let's see what happens next, right? So in this case, right, I'll just remove the Fib extension since it looks a bit messy, but at least you know how this second blue line come about. We actually use the Fibonacci extension to kind of like project, right, where the price could go, right? So we can just take advantage of that extra little pips, right, as the market break down lower. So what I mean by this is that, example, this is the swing low. Market break this swing low by quite a little bit before it makes a pullback. So the question is, where exactly, right, do you take profits, right, as the market breaks down lower? So this Fibonacci extension gives you that a little bit of objectivity to it. Okay, so I'm just going to remove this Fib extension first and see what happens. So in this case, the market, you can see that it pretty much went lower over here and hit our first target relatively quickly. Market continued down lower over here, almost reaching our target here, and didn't quite. And now it's making a pullback. And as you can see, this is how the market is right now. So at this point in time, right, so what you can do is actually, your stops is already in place, your first target is already taken, and your stop loss is already at a logical level. It's still over here. So what you can do is, again, leave your stop loss as it is, right, and let the market either, hit this second target or hit your stop loss, right? Because there's really no point, trying to shift your stop loss, right, to break even, because again, there's a good chance you could get your stop loss hit at break even. So what many traders like to do in this case is that they set their stop loss to, let's say, break even. They bring their stop loss down to their entry point. But to me, that's not really very logical, because there is no kind of barrier, right? Because this is an area of resistance. If the market comes up higher and then hits down lower, you can see that in this case, right, you will get stopped out on your trade, right, on the second half of the position, and the market eventually hits your target and you're not in it because, you know, you give in to your fear. So usually what I do is that, you know, my stop loss is already at a logical level. I'll leave it as it is. My target is at this point over here. I know I almost got filled on the trade, but I didn't quite, so I'm just going to leave my plan as it is. Either it's going to hit my stop loss or hit my target. I already taken partial profits on this first target over here, so even if the second position hit my stop loss, hey, guess what? This overall trade will not really be a loser. It's probably could be more of a break-even trade or a very, very tiny loss. So at least that's my thought process to how I would, you know, go about handling this trade. Alrighty, let's have a look at another example. In fact, I'll give you 5 seconds. Look at this chart and analyze, right? Where is the potential trading opportunity? I'll give you 5 seconds. 3 for 5. Okay, let's get started, right? So this is actually a weekly time frame. Dollar against the Indian rupee on the weekly time frame. So I don't usually trade the weekly time frame, but you can see that the strategies that I'm sharing with you, right, can be traded across different time frames. So this one over here, right, notice this is the area of resistance. And what price action do you see, right, as the price approach resistance? If you say a crawler move into resistance, woohoo! You're right, right? So you can see a series of higher lows coming into this area of resistance. So if you ask me, right, there's a good chance this market could break out higher. So now where exactly do we enter? Where do we set our stop loss? How do we exit, right, this trade if it moves in our favor? Fantastic question. So let's get to it. So one potential trading setup that you can consider is to have the market, right, break and close above resistance. So let's say I just have this line over here, right, horizontal line. Let's put it here in black. Let's say if the market area of resistance and it breaks and close above it, that would be a valid entry trigger to go long, right? So you can enter on the next candle open, let's say somewhere here, your E is for entry. Now, what about your stop loss? So where at this point, right, would this breakout trade be so-called a failed breakout, right? There are a couple of ways you can set your stop loss, but if you want to be a little bit more aggressive, you want to get a tighter risk to reward, or rather a more favorable risk to reward on your trade, you can set your stop loss, right, somewhere about here. Okay, around the $82 price point. Because if you think about this, if the market reaches your entry price over here, breaks out, and the next few candles, it goes back into this so-called range, you know that the breakout has failed, right? If not, you know, it wouldn't have, you know, gone back into this range, or, you know, back into this ascending triangle pattern, if you want to call it. Right, so you can set your stop loss somewhere about here. Now, what about your exits? Where do you take profits if the market moves in your favor? Great question, right? And because if you look at this market structure of this currency pair, you look left, it's quite insane. It's actually in a multi-decade, right, long-term uptrend. I'm just going to zoom out. You can see since the 1980s, right, the dollar against the Indian rupee is in a very long-term uptrend. So of course, I don't expect you to ride such a long-term uptrend because by the time you'll be a grandpa already. So what you can do instead is just to ride a short-term uptrend. And one way to go about it is to actually use the 20-period moving average. So you can see this red line over here. So what happens is if the market, let's say it breaks out higher, okay, you go long, then boop, 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 goes up higher in your favor, then this red line, right, will naturally, the 20-period moving average, the 20-week moving average will naturally move up along with it. And if it closes below it, okay, let's say it closes below the 20-week moving average, then you exit the trade. So I just take you back a few examples. You can see, right, it has happened a few times over the last few years, right? So you see, for example, just illustration purposes, yeah? Okay, so if you look at this, let's say we had a breakout over here. Okay, let's say your stop loss is, you know, below resistance, let's say somewhere here. Okay, and notice, let's say this is the exit that you have, right? Notice the market at this candle pretty much break and close below the 20-week moving average. So this is where you exit over here. So in other words, in this particular example, okay, cherry pick example, as you can see, your entry is here, E, right? And your TP is kind of like over here, right? Your take profit is over here. So you actually did ride this kind of like short wave up higher. What if, right? What if, right? This is a bonus section, right? What if the market doesn't break out? In fact, it starts to consolidate and comes down lower. Well, actually, if you've been paying attention earlier, there's another potential trading opportunity, right? Let me highlight it to you. So let's say, okay, you know that this is an area of support. So if the market comes, let's say a power move, right? Just learn the power move. Boom, right? Comes into this area of support. Guess what? Are you looking to long or short the market? Give you 3 seconds. 1, 2, 3. Answer is you should look for buying opportunities because you can look for a reversal, right, up higher, and thereby allowing you to capture that one swing up higher into resistance. And again, with proper trade management, it's possible, right, to exit a portion of your trade at this highs and then to let the remaining half ride even higher. So I don't want to get into this stuff, right? Because it's outside of the scope of this video. But what you can look for, right, for a potential trading opportunity in this case is, again, very simple. I'll just walk you through quickly. Let's say the market comes into this area of support. You can look for something as simple like a hammer candlestick pattern, a bullish reversal candlestick pattern. You go long on the next candle open, stops a distance below the lows, possible target just before resistance, right? You know, to capture that first target. Yeah? Okay, if you have enjoyed this training so far, then you will love, right, this book called Price Action Trading Secrets. It's a 142 color pages, right, trading book where you'll discover price action trading strategies, right, and, you know, to help you become a consistently profitable trader. So you'll learn things like, you know, how to draw support and resistance, identifying, you know, key reversal candlestick patterns, risk management, position sizing, breakout trading strategies, you know, pullback trading strategies, and much more. So I'll put the link somewhere below this video so you can grab a copy for 1990, right? We will ship this book to almost anywhere in the world, and 1990 includes your shipping fee as well. So that's it, right? So I'll put the link somewhere below this video. Grab a copy if you are interested, and I will